and thank you to the team at Pengana generally. It's a great pleasure to be here in Sydney. This is my first ever visit to Australia. I arrived in Brisbane on Sunday. We did a full day in Brisbane yesterday, and I have to say the jet lag is beginning to catch up with me. So if I lose my train of thought and start dribbling off somewhere halfway through, then just bear with me. I'll come back to it in a moment. But it's fantastic to be here. We're delighted to be in partnership with Pengana over this new fund. I'm slightly disappointed that this event and this week is organised for now rather than in 6 weeks' time when the cricket starts. Although, given the behaviour of the English cricket team outside nightclubs in Bristol, then maybe it's a blessing that I'm not exposed to greater humiliation than I'd otherwise be if I came out when the cricket was actually on. So my name's George Latham. I'm the managing partner and the CIO of Web Asset Management. We're a boutique investment company, specialist investment business, focused entirely around sustainable investing. And we have a 12-year track record with the strategy that we run that I want to talk to you about today. But before I talk directly about the strategy, I want to talk to you about an Austrian economist by the name of Joseph Schumpeter. Those of you who read The Economist magazine regularly may recognize the name from one of the columns that is written in his honor, I guess, many years later. This is a picture of him in the 30s when he was a Harvard professor, looking slightly more relaxed than I imagine he did in the 20s when he was the finance minister of Austria. But his thesis, or a lot of his description of the way that the economic system works, around the way that the capitalist system works, was this process of creative destruction, as he coined the phrase. And that is a process of continual renewal of industries. As new technologies, new innovations rise up, and old industries are competed out of business as this process of change comes through. So this is a description of a dynamic economy that is continually in flux and is continually changing. And I want you to hold that thought in mind whilst I talk about another economist, this time a Venezuelan economist by the name of Carlota Perez, who's slightly more recent in terms of her timing. But she describes a series of industrial revolutions, if you like, from the original one in Britain to more globally based change. But in each successive period of change of industrial revolution, spurred by new innovation, the advent of steam and the railways, the advent of steel, electricity, and so on, oil and gas as a cheap source of energy, and the IT revolution, obviously. And each industrial revolution, each successive one, is more far-reaching and on a grander scale and more rapid in terms of its rate of adoption. And the current one is unusual in a sense, is that it is not just responding to innovation, it is also responding to necessity. So when I was born in 1970, there were 3 billion people, or just over, on this planet. There are now over 7 billion people on the planet. And depending on which forecasts you believe in, then we're going to reach 9 or 10 billion by the middle of this century. Within that context, we're also all wanting to achieve higher standards of living, which relate to higher levels of consumption, higher levels of resource use. And so we have an exponential use of resources in a world where planetary resources are, by definition, finite. And so that challenge, that problem, with a growing population, an aging population, higher standards of living, but resource scarcity, is at the root of the sort of sustainability crisis, if you like, or the sustainability challenge. And that's what's driving a transition of the global economy towards a more low carbon and a more sustainable basis. And this transition is underway here and now. The way I describe it, things are happening now. And it's not just an opportunity. For many, it is an opportunity. But for many traditional industries, facing that process of creative destruction, it's a threat, it's a risk. If you're sitting in the coal industry over the last 6 years, then that industry has lost huge amounts of value as the dynamics of consumption have changed, and some very well-known and established and companies with good longevity have gone out of business altogether. And one of the reasons behind this is a fairly basic set of maths that I'm just going to talk about for a second. 2 years ago, in December 2015, in Paris at what was known as the Conference of the Parties, the 21st attempt to do so, 192 countries reached an agreement that they would make all steps to try and achieve a target of a maximum of 2%, of 2 degrees of global warming compared with pre-industrial levels, with an ambition lower than that, at 1.5%. This is a piece of work that was done by some former colleagues of mine under the name of the Carbon Tracker Initiative, which basically looked at the Intergovernmental Panel on Climate Change, the scientists' view on what we needed to do in order to be consistent with trying to achieve that target. To achieve that target of 2 degrees of global warming, we have a budget between 2013 and 2050 of 900 gigatons of carbon being released into the Earth's atmosphere to have an 80% chance of hitting the target. If you set that against the amount of carbon that's embedded in the reserves of the oil and gas and mining companies, national companies and listed companies, that is the basis of their valuation, the basis of their asset base, that reserves is 3 times the budget we have out to 2050. So there's a basic problem here that the two don't add up. Either we aim for 4, 5, 6 degrees of global warming, which is, 2 degrees is pretty catastrophic. That's unimaginable, really. Or we do take steps to hit 2 degrees, and we've got a problem with stranded assets, that an amount of that carbon is unburnable. And that is a problem not just for the coal industry, it's a problem for a lot of the basic resources companies and a lot of the fossil fuel companies. And it is the manifestations of that are changing markets very rapidly, and they're changing markets today. So when I started my investment career in the mid-90s, kind of rule 101 or lesson 101 in terms of where you went if you wanted to be defensive, if you wanted to preserve capital, if you wanted to avoid losing money in equity markets, was one good place to go was regulated utilities as a defensive place to invest. So if you've invested your money in the German national champions, regulated energy utilities over the last 10 years, you've lost 80 to 90% of your money because the shape of that market has changed fundamentally as the structure of the German energy grid has become much further biased towards renewables, and these companies, RWE and E.ON, have failed to invest to keep up, and as a result have lost not just share, but lost their exposure to the market dynamics, which have fundamentally changed in the way that people make money. This idea of the risk of creating stranded assets across different industries can pop up in a slightly unusual and unexpected ways. So a lot of people put the crisis at Volkswagen in terms of the emissions scandal down as a crisis of governance. Well, that was a second derivative. That was an echo of what the real crisis was, and it was an externality becoming internalized. So the external cost of the internal combustion engine on society, on the commons, is the pollution emissions that they emit that the company doesn't pay for that produces the car. Now, that externality is becoming internalized into the profit and loss account, into the economics of the car industry through ever-rising standards that are being put in place by regulators around the world. And that is creating such pressure on the R&D budgets, on the manufacturing cost base of these companies that in this case, in Volkswagen's case, they were encouraged to cheat in the end, the system. And that kind of sort of standout event, as we had with Volkswagen, is the sort of thing that then leads to more rapid adoption of change. So we now, so before I say that, actually, what we're talking about, as I say, is a negative externality. On the flip side of that, there are other businesses that are encouraging the change, that are contributing to helping enable and benefit from this change. So where you have positive externalities of businesses, so negative externalities of businesses which are at risk of seeing a process of creative destruction. On the other side, you also have opportunities to companies which are part of the solution, or companies which are solving those problems, creating positive externalities, if you like, common goods. So Hariba is a business that makes the testing systems that actually found out Volkswagen. Hella makes LED light bulbs that go into lamps at the front end of cars that help them be lower carbon in the end. Littelfuse and AMS make sensors that are related to power management and safety. TE Connectivity and Norma make clamps and component parts that are part of the electrification of the value of the drive chain in the automotive industry. So where there is these challenges to some of the traditional industries, there are also new industries and new dynamics and new technologies that rise up to create opportunities. But the events like what we saw at Volkswagen are accelerating this process of change. So this is now the forecasts from the Bloomberg New Energy Finance of the adoption rate for electric vehicles, which is now expected to reach 50% of the fleet by 2040. A third of the fleet and 50% of new cars by 2040. And so that has driven over the last 2 years the change in the development of new technology around electric vehicles has been spurred very rapidly. So recently Volkswagen announced that they were going to stop producing pure internal combustion engine cars altogether by 2020. The likelihood is that those forecasts are probably going to be too cautious. If anything goes from the experience previously of the adoption of renewables to date. So this is Bill Gates had a famous expression that we always overestimate what's going to happen in 2 years and underestimate what's going to happen in 10. And this is very true of what we've seen with the adoption of renewables. This is about solar. I could have put the same chart up, or a similar chart up, about wind. In 2004, forecasts were that by 2030 we would achieve maybe 100 gigawatts of installed power for solar across the world. Actually, what's happened is that every single year since, the forecasts have been beaten and had to be raised. And we're continuing to see that outperformance of the forecast in terms of the adoption rate of new technologies. So much so that we now expect the supply of energy to flip from a 2/3 fossil fuel, 1/3 renewables basis as we are today, to the other way around, 2/3 renewables, 1/3 fossil fuel. And that's whilst the total amount of energy produced, or electricity produced, doubles. And within that fossil fuel portion that looks like it stays similar is a huge change from coal to gas. So enormous amounts of flux for companies to deal with, and that'll be challenges for some and opportunities for others. But it's not just environmental challenges that are at the root of sustainability. I could have chosen any one of a number of subjects to look at social challenges that are at the root of rising standards of living, the challenges of an aging and a growing population, and they need to be addressed as well. So these are across a broad spectrum, and I've alighted on obesity, which is becoming a global epidemic. I'm drinking a Coca-Cola today because I'm trying to keep the energy levels up a little bit, but I think that may be one of the new stranded assets in the future. We saw just last week the struggles that Pepsi are having in terms of trying to transition their portfolio from the sort of sugary drink side to the more the healthier food side. And again, so you have this sort of dynamic of change in the industry. There's all sorts of different areas that rise up in trying to address this problem around that comes from unsustainable or unhealthy lifestyles. It's not just that a consequence of the growth in obesity is an endemic or a pandemic in diabetes as well, which is to date largely untreated. So there is significant growth in markets to treat diabetes. So insulin businesses like Novo Nordisk, or dialysis treatment businesses like Fresenius Medical Care. But there's also a cohort of companies to do with healthier eating, Christian Hansen, or more active lifestyles such as Nautilus or Tivity Health, makers of the silver sneaker. And so this happens across a broad range of spectrum and a broad range of opportunities. But this is about trying to rethink or reframe the traditional concept of sustainability or sustainable investing with reference to externalities, if you like. I think a lot of people, when they hear someone's going to come and talk about sustainability, expect someone with a beard and sandals and a hemp shirt to come and speak on the stage. But really, what we see is that there is an element of the traditional market and the traditional economy where there is a risk of stranded assets and a risk of a permanent loss of capital as a result of this process of creative destruction. There's a lot of the market where environmental, social, and governance challenges are a risk to how you do business. They're a risk to be managed if you're a Unilever or the like. But actually, if you are a Unilever is a brilliantly run business from a sustainability perspective. But in the end, ice cream and shampoo is not something that is contributing to a positive externality or a positive change. So what we're looking for is businesses where the growth in their business, the growth in their revenue, the growth in their profit grows in lockstep with a better outcome, a better impact from a social or an environmental perspective. And all of that is not future-gazing. As I've said, some of the challenges are already here. That the German energy utilities have already lost a lot of value. And a lot of the technologies, a lot of the change that we see coming through markets is here. I think it was William Godwin, a sci-fi writer, said the future is already here, but it's just not evenly distributed. And as we go about our daily lives, this is a representation of today, and a lot of this is happening here and today. But I'm going to change pace a little bit and or change gears a little bit and talk more directly about how we try and capture all that change in an equity strategy, in a portfolio strategy that is targeting better risk returns than other global equity strategies in the way that we invest over the long term. So our investment process, at the core of our investment philosophy, is a desire to try and find an attractive balance between growth, quality, and valuation. We're looking for high-quality businesses that are operating in growth markets in a world where growth is increasingly scarce, as I tried to describe, and be disciplined about valuation. We can buy high-quality companies in growth markets and overpay. We're still making a bad investment decision if we do that. Sustainability lies at the core of all of that, but more than that, long-term investing lies at the core of all of that. We have a 5-year average holding period, which is far longer than the average manager of a mutual fund. And it's only in that context that all of this makes sense. So I'll go into each in a very small amount. So we only invest in companies which are providing what we call a solution to a sustainability challenge, that are at the positive externality, the positive impact end of that spectrum that I tried to describe earlier. Companies where the positive environmental or social benefit grows in lockstep with revenues, and it's a driver of future revenue growth. That definition actually leads us to a broad range of investment themes that are both social and environmental. So alongside health and education and well-being, we have environmental services, water and sustainable transport, resource efficiency and the like. There's a broad spectrum of investment types, as well as a broad spectrum from a holistic view of sustainability. And the unifying force is that there is strong growth characterized by the universe as a whole. We have a universe that we've built over 12 years, a database of 1,050 companies that are mid-cap in orientation that meet this challenge. When we pick stocks, essentially the team are fundamental, bottom-up, long-term stock pickers in what we do. We want to have a holistic view of the way companies are run. We find that an analysis it's fundamental to understand the report and accounts, the balance sheet, the cash flow statement, profit and loss account. But it gives you a snapshot, and quite a narrowly based snapshot, of where a company is today and how it's got there. It's not necessarily all that good at helping you to calibrate the future. And all we mean by environmental, social, and governance analysis is a route through to trying to identify other features, a broader analysis of how we identify management quality, of corporate quality, so understanding how well invested a business is, understanding the extent to which that business is likely to be able to sustain and grow its franchise and have sustainable returns from the theme in which it operates. That's what we mean by ESG analysis, and it's an integral part of the way that we select stocks and choose companies to invest in. The other terminology that people, alongside ESG analysis and CSR and all sorts of TLAs or three-letter abbreviations that people come up with to describe this place that confuse people, the other terminology that gets used a lot is engagement, which is really about turning what's traditionally been a slightly sort of one-way conversation between investors and management teams into a two-way dynamic. And that becomes relevant, again, if you had that longer-term perspective and that longer-term average holding period. So we do have quite an engaged relationship with the companies we invest in. We want to help those companies, we want to encourage those companies to have better governance, better standards in terms of the way they approach their own footprint to address the challenges and opportunities that they face from a stronger way with a long-term framework. We want to encourage those teams to be, those companies to be run for the longer term. We also engage quite a lot at a policy level. So we were core members of the IIGCC team, which did a lot of engagement, was very contributory to, was a lot of the people involved in the negotiations in Paris in 2015 name that, the contribution that the financial services sector made, and specifically within that the IIGCC, which is the Institutional Investors Group on Climate Change, had towards achieving that stronger outcome. And we look to measure how we do in terms of what the actual positive impacts are from the portfolio. But it means that a lot of these labels, a lot of these sort of slightly amorphous concepts of ethical or ESG or stewardship are not inputs into they're not controlling factors or inputs into how we define the portfolio. They're natural outcomes of the way we invest. And they're often a natural outcome of just having a longer term investment time horizon. And so we don't look as a priori as a starting point to impose a set of ethical criteria or ethical screens on the portfolio, but because we're only looking for companies that have a positive impact, it means that the portfolio that results from that is consistent with pretty much every set of ethical criteria that I've seen. And a common thread of all of it is the importance of being longer term in terms of the way that we approach it. And because we have this focus on output and impacts and what we're actually achieving in terms of the companies that we're investing in, gives us a very solid basis to be able to communicate better with our investors and give you as advisors stronger tools to communicate to your clients what your money is doing. So alongside, obviously, being able to talk to them about their return and the investment return they're making, what is the social or the environmental return in terms of the impact that their money is having? How is it contributing to making a better outcome as a result of the way that they've invested? And so we've now started through doing some really quite granular and ground-up work at a company-by-company level through the portfolio, to be able to discuss, to report to clients on the amount of renewable energy that's associated with a certain amount invested. Pengana have kindly translated our original analysis into Australian dollars, and I think on the new website you're going to also we've got a calculator on our website so that any advisor can sit down with their client and put in the amount that the client's got invested, and it'll drop out what the impact is associated with that particular investment. And I think that's something that's coming through in the Australian version as well in time. So we found it in the UK to be a really engaging tool to work with clients, for our advisor clients to work with their end clients over. So I'm just going to describe a little bit about some of the investments we have, just to give you a sense of the diversification in the portfolio. Because one of my bugbears, which I'll try not to get onto now, is about benchmarks. I think a lot of people obsess about benchmarks and tracking error. We think about risk very hard. But we think risk is related to the risk of a permanent loss of capital, and that needs to be addressed inside the investment process. And we also think risk relates to concentration risk, or concentration of where exposures are. So a lot of our risk analysis is about the diversification within the portfolio and the diversification of end markets that we address. So we believe that we have very good diversification, although we are very active relative to a benchmark index. So against the MSCI World Index, we have a 98% active share. That doesn't mean that we're putting all the bets on red. The two biggest themes within the portfolio, we won't have one theme over 30%, but the two biggest are resource efficiency and health. You'll notice that clean energy is not the dominant theme at all in the portfolio. It's 6% of the portfolio today. Education is also quite small today. It's 2%. They're dynamic, these, and we don't have to be invested in all of the themes all of the time. So there have been periods, quite long periods at times, when we've been out of cleaner energy altogether. We don't feel forced to own it. We've been out of education altogether for periods as well. So that allows us to try and be objective and avoid bubbles forming if areas get too popular and too expensive and the like. So within that, even within some of the themes, there's quite a lot of sort of heterogeneousness, if you like, or they're diversified within themselves. So resource efficiency really meets four different areas. It meets energy efficiency, materials efficiency, buildings efficiency, and manufacturing efficiency. And so we have those are very different end markets and times, and so we have investments that address all of those. And so even within the resource efficiency theme, there's quite good diversification. So A.O. Smith makes very clean, very energy efficient water heaters. Kingspan insulation materials, Acuity Brands is LED lighting. I don't think these are. And Renishaw is very precise measurement in the manufacturing process. ANSYS allows for computer-aided design and in the design phase, which allows for much more energy efficiency or materials efficiency as well in manufacturing. Within health, an important thing, we're looking for solutions to sustainability challenges as a driver of long-term return. So our theme as we describe health is very different from GICS health or the sort of benchmark health. We don't have much, if anything, in pharmaceuticals and biotech, because a lot of them can't really be described as providing a solution to a sustainability challenge. We focus much more on prevention rather than a cure, so diagnostics and original research, on cutting costs in the healthcare system, which can lead us to some IT, on the challenges of managing aging demographics or tackling obesity, as we spoke about, or preventative care. So there's a broad range again. It's different from the index, but it's diversified as for itself. So hopefully that gives you a bit of a sort of view of how we think and how we invest. This is our we've only been running the Pengana Web Sustainable Impact Fund for 2 months, so the track record sounds very short term, but actually we've been running this strategy for 12 years. So we've seen how the strategy behaves and how we behave and how it operates in different market cycles across different time periods. And so it has a level of tried and testedness, if you like, to the approach that we have and the exposures that it gives. But now, and for the last 5 years, with two partners, we're building a partnership business, which is a boutique specialist. This is all that we do. We are a mission-oriented organization, so we are able to run the franchise, and we have a desire to run our franchise consistently with the way that we invest for the portfolio. So we look to be aligned with clients. We look to be radically transparent in the way that we disclose on our portfolio. The sustainability side of it is not a bolt-on. It's not a module that you can attach onto the side of a portfolio to make it sustainable. It is built in as the root cause, the root source of our investment return. It's how we invest and how we look to drive performance. And that's through looking for these solutions to sustainability challenges. But at its end, essentially we're investors, not traders. We're fundamental, bottom-up, long-term investors, quite old-fashioned in a way. We run a 60-stock, long-only, diversified portfolio. It's just very focused on the way that we see the future developing and a way of having a broader range and a more in-depth range of views on how we find corporate quality in a long-term construct. So thank you very much for listening. Thank you very much for your time.
I think it's interesting that someone comes to Australia and apologises for their cricket players. I'm not sure that that's necessarily been required recently. Mark Christensen is my name. I'm part of the Australian Equities team. I've been asked to present on the new income fund that we're launching as part of our team. I guess it's active now, but it'll officially be launched, as Damien said, about 1st of November. I've been asked to give a presentation which I could easily do over about an hour in about 15 minutes instead, so if you can bear with me, I'm going to try to go through it quite efficiently. Anything I breeze over too quickly, please write it down and save it for a question afterwards. The team before you, Chris and I are very excited. Chris is here today as well. We're very excited at the opportunity to manage this fund. We've both been part of the Australian Equities team for the last number of years and have sort of further experience in broking, in research, etc., at various institutions before that. We're not doing it in a bubble. We're very pleased to be able to draw on the experience of Rhett and Anton. Many of you will be very familiar with these guys. Given Rhett is, in fact, not here, he's in Melbourne today, I can confirm that the experience, the over 80 years experience, there is an inverse correlation between the amount of hair you have on your head in that slide and where all the experience lies. But as I said, he probably still heard that, so I'll move on. Don't want to spend a lot of time on this slide, but it's really just a scene setter, something that you're all very aware of. We have a very obvious, a very powerful demographic trend, which is seeing the age cohort of 65 and over growing much stronger than other age cohorts in Australia. In fact, 65 and over is expected to more than double over the next 30 years. So that has quite profound impact for all of us in this room, in that cohort is very much an asset-rich, income-poor cohort, and therefore that there is this demand for a yield product, for an income product. We've received that via questions in the core fund for the last couple of years, which has spurred us really to launch this strategy, and I'm sure it's something that you guys deal with every day. So if we accept the fact that we say, okay, there is a demand for yield, and Chris and I start to apply our mind to how should we think about managing a yield fund income, we come across a bit of advice here from Raymond DeVoe. I don't know if any of you are students or have read some of his comments previously, but he makes the point to say more money has been lost reaching for yield than at the point of a gun. It sounds a bit dramatic, and most of his comments are actually more hypothesis than actual studied theories. But I guess that the point that he really makes out of it, and something that which we all need to take away, is that certainly if reaching for yield or if achieving a yield target is your primary or is your main focus, then it's very easy to lose sight of the additional risk that you take on every 10 or every 20 basis points that you reach. And human nature really does make you reach that little bit higher, particularly if you have set or defined targets that you need to meet. So if Warren Buffett sees it appropriate to quote him, then I feel I can do so here as well. And it's a big warning sign before you actually approach the space. So, let's really keep that in mind. But having said that, if we say, well, what has been the experience of yield investors, of this sort of subsector of the market over the last 7 or 8 years? And well, actually, Ray DeVoe might have been a little bit too bearish, because these traditional sectors, banks, property and utilities, have had a very strong run. There's not obvious pitfalls in that sort of in that journey. And we all know what the slide tells us is that we've had a period of declining long-term bond yields. You can see it's gone from 6% to 2%, and that's provided a real tailwind to investors and these sorts of products in the sector. Two ways really. The first way is obviously highly geared companies that benefit disproportionately from lower costs of debt. So utilities is a great example there, and the red line shows you they've been a big benefactor. But also, just generally speaking, the relative attractiveness of income-paying equities has increased over that time. And even now, particularly on a post-franking basis, there's still a lot of places in equity markets that are much more attractive to the income investor than a simple government bond. But again, we're focusing here on what an absolute yield is. We're not yet considering the other side of the equation, which is the capital risk that we take on every time we do invest in equity markets. And it hasn't all been one way. That there have been plenty of examples. I've just picked 3 here of real traps. I returned to Australia in 2011 as a sell-side research analyst covering Goodman Fielder. And I put a sell rating on it straight away, and I got told by a lot of people, it's got a 10-11% dividend yield. How can you put a short on a stock like that? Obviously it kept going. It sort of halved from that point. The dividend fell away, and obviously that story didn't end very well. Even more, more blue chip companies like Telstra and Coca-Cola Amatil. To George's point before about Coke, I mean, Coke has been a good solid 5-6% dividend payer for as long as many in Australia can remember, but that sort of a yield is no good when your share price has gone from $16 down to $8. And so yield investing can be tricky, is the point. We have to give a lot of thought to the sustainability and the risk that we're taking on for every 10, 20, 30, 50 basis points that we reach for. So again, that just sort of sets the scene a little bit. So we take all that on board and we say, okay, well, how are we going to design, how are we going to approach running an income fund for investors, given that sort of a backdrop, and obviously there's much more to consider about income markets. Well, the first place we start is actually the place that Red and Anton started 9 years ago when they set up the Core Australian Fund, and that is to actually say, look, what are investors' actual needs? I would suggest to you that an investor in that 65 years or older cohort, which doesn't have years of income producing ahead of them, their first and primary need is capital preservation. Okay, this is an investor group, and actually I'm 40 years old. I think it's appropriate to me, but it's a particular investor group that needs to preserve capital first and foremost, and we believe that is the first need of every investor. The second need is you need to have a return commensurate for investing in equity markets. So here we don't think investors' needs every year is to outperform the market by 20 to 30%. That's certainly an investor's want, but it's not necessarily an investor need. If you are going to invest in equity markets, and this is our philosophy for the core fund as well, we think you need at least around about that 2% cash, plus academics will tell you an equity risk premium is about 6%. So if we take those two round numbers, we think 8 to 10% with a primary focus on capital preservation. If you can deliver that every year, that will be meeting investors' needs. From an income point of view, we talk about that the deliverable being mostly in the form of income. So we set ourselves a little bit of a motto, if you like, or a little bit of a statement to say, how are we going to approach this? And this is what we come out at, just to summarise there. Well, Chris and I, we aim to provide a common sense approach to actively manage an investment portfolio with the primary focus being on capital preservation, and where a substantial component of the returns are delivered in the form of income. Now, it's on purpose there that we don't say an ASX 200 yield plus 200 basis points, etc. We think that doesn't allow us to meet investors' needs, and let me talk about that in a moment. Is just this conservative capital preservation and a reasonable return the right model? So this is the core fund over the last 8 years, and then the core fund's performance is in the dark blue charts there. Particularly you can see over the last four-year period, but go back further beyond that. The fact that there hasn't been a negative year, so that focus on capital preservation, and just that consistent delivery of 8 to 10% every year while the market might go around you, does prove to be deliver a superior return in the long run. So this gives us confidence that this is actually the right approach. So we go then to our fundamental beliefs. And I don't have time to go through all of these. Of course, as Damien mentioned, limiting capacity of the fund is fundamental to performance of the fund, and we'll be very conscious of that. We are tax aware. We believe it's important that fund managers are invested alongside our investors in the fund. That's the case for the core, and it is the case for the income fund as well. But the three that I want to touch on just now is capital preservation, benchmark unaware, and our philosophy on cash, which is to say, if we can't find investments that justify the risk, we stay in cash. And a common sense mandate allows us to be up to 100% invested in cash if market conditions actually dictate or suggest to us that that's appropriate. Let me talk about that in a moment. First of all, benchmark unaware and how we think about risk. And this is a slide where we compare ourselves to index trackers. And we understand in the world that there's a place in investment land for all sorts of different managers, and so I don't want to be seen to be standing up here putting other people down, but this is how we think about our approach versus others. An index manager, someone who is managing to deliver a target, let's say again, ASX 200 plus say 100 basis points. Their perception of risk, if you like, is I have to make sure that I own, first of all, probably all the banks. I probably need to make sure I own Telstra. I need to make sure I own Transurban, Sydney Airports, all of these. And if my tracking error varies a little bit from that, then I have a huge personal risk of delivering a result which varies from that benchmark target that I'm aiming for. Now, I would argue that's not consistent with my identification of investors' needs of capital preservation, because if I'm that manager, I could be thinking, you know what, Transurban at the moment's got a high load of debt in an environment where interest rates could actually start going up pretty soon, plus it's pretty expensive. I don't think that's in my investors' capital preservation best interest. But if I don't invest in it, my tracking error goes up and I deviate too far from that target, so I've got to invest in it anyway. That's not a philosophy that we feel very comfortable about. When we approach investments, we think a lot more about, just first and foremost, what is the risk of losing money in this investment, and is it going to generate us the appropriate return? It's that two different perceptions of risk which actually influences your decisions and dictates the look of the portfolio every day, and that's a key difference with how we have managed the core portfolio historically and how we will manage the income fund as well. So capital preservation, everybody talks about capital preservation as a focus. We've got a broad toolkit of tools that we use to make sure that we can enhance that. We make sure that we're not invested in highly economically sensitive stocks, cyclical stocks that are going to be boom or bust. We like to make sure we maintain a very disciplined investment process, which keeps us true to our word and keeps us on the right side of cycles. We like to build in a large margin of safety to make sure that, okay, even if we were wrong, we must be very wrong before it hurts us. And we do use on occasion various options to give us some downside insurance in the fund. It's not an active part of our strategy. It's just a tool we have at our disposal. But perhaps the most significant tool that we have to preserve capital, and this leads into the next belief, is that ability to stay in cash. And that fundamental belief that if we cannot find investments that will satisfy those two goals of protecting capital and sufficient return, then we stay in cash. And I understand this feels a little bit, this has been a little bit challenging for investors to digest over time. Our investors in the core fund who have come with us have begun to realise and appreciate the benefit of the strategy. But the one thing I want to point out about it is that we don't all sit around a table and decide this week it feels like we should be 20% cash, next week we should be 25% cash, because we're very smart economists and we just know that that's the case. It's a bottom-up process to us. So we come to work every day and we want to be 100% invested in equities because that's our job and that's what excites us. But the truth of the matter is that we can't come in every day and find things that, or we rarely can come in every day, find things that satisfy all of our criteria. And if we do that, we're not just going to be invested for the sake of it and risk losing our investors' money. So cash is an outcome of available opportunities. And I can put up charts to show you how that evolves over time. But good examples are that typically in expensive markets, you will find our cash piles will go higher and higher and higher because we see fewer opportunities. When those typical corrections do come, we find ourselves with a lower exposure from an equity point of view, but also a large cash pile that we have ready to deploy as opportunities present. And I mean, the Brexit day was one great example. We went into that with quite a high level of cash, and we deployed about 15% of the portfolio in one day, got a lot of stocks very, very cheaply. Rhett will tell you it was not a very comfortable exercise, but you position yourself the right way, you have the discipline of your investment process, and those sorts of opportunities you can capitalise on. So the main message there being cash is an outcome of available opportunities. Okay, our investment process, again, this is another hour discussion of itself. I really just want to make 2 points about this slide, and if anybody wants to talk about the investment process, please ask me afterwards. But the 2 things are, the first thing is that this is the identical investment process to the core business. We're the same 4 guys sitting in the same 4 desks, doing the same 4 things we do every day, we have done for the last 9 years, using the same process. So the idea generation, the discussions, the debates about what is a good business, the criteria that it needs to satisfy, right down to the valuation metric of the after-tax cash earnings yield. The only difference is that final hurdle. For the core fund, we've always asked ourselves the question, if this business is generating a 6% cash yield now, can we reasonably forecast that to grow to 10% over the next 3 to 4 years? Agnostic about whether the deliverables in income or in capital, we just need to know that the cash yield can get from 6% to 10%. If it can, it's a candidate for the core fund. In the income fund, we get to that last stage and we say, you know what? Income-paying businesses will typically return a high level of the cash they generate to shareholders. That's what we like about it. If you're doing that, then you're probably not going to be fortunate enough to be getting a whole lot of growth thereafter. So for the income fund, we might not be able to say this 6% yield is growing to 10%, but we can satisfy ourselves to say, you know what, this 6% yield can grow a little bit every year, and we think it's sustainable. And if we can satisfy ourselves that that's the answer, then that stock is a candidate for the income fund. But the funnel that it goes through and the process and the minds and the debates and the people that get it to that last hurdle is exactly the same as the core fund. So point number 1. Point number 2 is we're in the business of identifying good businesses. Okay, we're not looking to craft a bond proxy portfolio. So we're not just doing simple screens, ranking all dividend yields and saying, let's just do the top 20. We're very much about identifying good businesses, and let's talk about that further in a moment. I've got a slide here which, unfortunately, and this doesn't sound great, time doesn't permit, where I could go through a company as Aventus and I can talk you through our investment process. Anybody wants to do that, please write it down and let's talk about it in Q&A. Damien's going to get angry at me if I spend any more time on it right now. So what does the portfolio look like today? Again, so we've got here the top 10 stocks on the left-hand side. The first point I would just return to the fact to say, if someone was to lay those 10 stocks in front of you, would it stand out to you as an obvious income yield portfolio? I hope you're saying, well, not obviously. As I said, where's Sydney Airport or Transurban or where's Mirvac or Stockland or some of these more traditional yield names that you probably see? Again, that's not accidental. We are not just simply yield investors. We're good business investors that happen to find good businesses generating good cash flows, sustainable cash flows that can actually pay dividends to shareholders and feed our income needs. The other point I'd make just there is that there's a number of stocks there in the top 10. Nobody might recognise IVE Group. I don't know if anybody does know IVE Group. The likes of Viva Reed, Z Energy, certainly not top ASX 50 stocks. If we identify stocks that we think can actually make a positive impact, we can hold them in whatever weight we think is necessary. So, and that's the absolute focus, the benefit of having that absolute focus. On the right-hand side, we've got quite a broad sector exposure, so we're not overly exposed to any one particular sector. Financials does say 22%, but there's about 7 or 8 points there in diversified financials, the likes of SG Fleet and Smart Group, etc. So we're not just all about the big banks, even though we do hold a number of them there. We don't have targets, and things could change, but just a few metrics around how the portfolio looks. It's currently on track to deliver about a 5% dividend yield, about 6.5% or better after franking. It's got about mid to high single-digit EPS growth across the portfolio, and a PE of about 12.5 times. There's some broad metrics about what it looks like. So we weren't given a cash box through the Hunter Hall Trust. We did actually have to migrate from one portfolio to another. That transition has largely happened, and Chris and I hope are looking forward to deliver on this fund. So just to wrap up, I have a slide there which summarises the slides that we've spoken about so far, but really I just want to emphasise that as Chris and I run this income fund, we're very much doing so not with a focus to reach for yield, but with a focus to identify and find good, strong, sustainable cash flows that are committed to returning a high level of that cash to shareholders so we can deliver on what we think our investors' needs of capital preservation and delivering a reasonable return to investors, the majority of which should be in the form of income.
It is fantastic to be able to present in front of such a large audience, and it's a real honor for me, and thank you so much for your time to listen to what I have to say. My name is Antonio Meroni, and as you can probably hear from my accent and see from my name that I'm half Italian, half Swiss. So if you think about my genetic makeup, my Italian blood draws me to excitement and speed. But like all the Swiss, I'm also super conservative. And no, it doesn't make me schizophrenic, as Russell Pillemer repeat, and I assured him to Russell Pillemer, our Pengana CEO, that it makes me best suited to run this strategy alongside with my partner Vikas Kumra in Singapore. The Asian markets are, after all, the most exciting markets in the world, and we run a strategy that requires quick but qualified investment decisions based on rapidly changing information. But my Swiss conservatism makes sure that risk is under control and ensures that all the I's are dotted and the T's are crossed. So what I would like to do is quickly go through the team, go through the fund overview, the key strategies that we employ, and also discuss how funds such as ours plays a role in a portfolio. So with regard to the team, I spent almost half of my life managing portfolios and funds in different shapes and forms across the whole globe. And I've been a portfolio manager for almost 24 years. I started off my career with Credit Suisse Asset Management and bring along 15 years of Asian market experience, but also 10 years of Asian corporate events. Vikas Kumra, he brings along 11 years of market experience, and prior to joining me in 2008, he was with Credit Suisse. And what separates Vikas from me is that he has a photographic memory, simply, and that puts me to shame at times. So the key objectives of the fund is to have an alpha return in excess of 5% over the RBA cash rate. Secondly, we seek to have minimal correlation versus market and peers. And thirdly, capital preservation. We are very fortunate in that the Asian markets provides us with an abundance of alpha opportunities. And people are talking about alpha as something that is very hard to get and is very elusive at times. What we mean by alpha is that the return that is in excess of an index return that is not explained by the markets. So how do we do it? Well, we invest long-short in companies that are undergoing corporate events, and whereby these corporate events results in pricing anomalies. What we mean by corporate events is events that happen to companies such as buybacks, demergers, spin-offs, etc. What we mean by pricing anomalies what we mean is that the shares become either too expensive or too cheap because of these corporate events. And because Asia markets are very volatile, and you hear me say this a lot, that volatility is the friend of the event manager, it creates more inefficiency, which subsequently increases the frequency and the size of the anomaly. And finally, on this point here, there's not that many focused event managers out there that do what we do. And for the reason for that is they are simply way too large to meaningfully participate in those corporate events. For example, 70% of Asian M&A deals that come to the market are between the mid-cap and small-cap space. So these guys are missing out on great opportunities, but we can participate meaningfully in those. So what has the fund achieved? So we've been running for almost a decade now, and we've been annualizing since inception returns of 8.3% with a volatility of 6.1%. And these results suggest a positive Sharpe ratio. 8 out of 9 years we've had positive returns, and there's only been 1 year whereby we have a small negative drawdown, and that was not due to falling equity markets, that was a deal-specific situation. So here's another link of my Swiss heritage, if you like. I deliberately planted here the red cross, because we are the guys you want to have around if markets have accidents, and accidents do happen. So you can see on the far left, I plotted the biggest monthly falls in Asian markets, ranging from 20%, and I stopped at 7%. So, and we are able to preserve capital most of the time. The two more recent events in 2016, Brexit and Donald Trump election win, saw markets fall in excess of 5%. But had you called me on that day, I would have told you that the fund was completely ring-fenced and showed a positive outcome. And finally, the maximum drawdown has been 8% for our strategy versus a negative drawdown of 57% for Asian markets using weekly data points. Why Asia? So we all know how dynamic Asia is, the demographic changes in terms of population growth. We all know how strong the Asian consumer are and how strong those Asian economies are growing. Therefore, Asia cannot be ignored, as the rise of those Asian economies are creating larger liquid markets. And we've seen that with the Chinese capital market opening up through the northbound and southbound connectivity program. Asia is currently 27% of the MSCI Global Index and projected to be north of 50% by year 2030. And there is also very strong M&A deal activity as well. In the year 2000, Asia represented 12% of global M&A, and today is in excess of 30%. So just touching on two markets, Japan and China. China is in the early stages of an unprecedented overhaul of its state-owned enterprises apparatus. Therefore, the Chinese government is to see more SOE consolidation, form national champions, which ultimately will lead to M&A transactions and asset injections and higher equity valuation. Also in Japan, we've seen high level of consolidation simply because the announced governance reforms that has been introduced in 2015. And there is also an unprecedented focus on shareholder returns through higher dividends and a record number of share buybacks. Did you know, for example, that 32% of TOPIX members in the index in TOPIX in Japan are in a net cash position as opposed to only 8% in the United States? So as you can see, there's lots of activities across Asia-Pacific markets, which keeps both myself and Vikas very busy and very excited. And it's not just the Asian growth. It is the changing structure of markets and reforms that drives corporate events and mispricing opportunities. And also the situation in North Korea gives us the market volatility, and we are very happy about that. So how do we do it? We have identified 3 buckets. The first one is what is merger arbitrage, the second one relative value, and the third one directional alpha. Within merger arbitrage, our target return is 4 to 5% absolute. Within relative value, 3 to 4, and we aim to generate 1 to 3% in the directional alpha book. So if you add those 3 buckets together, we are getting to our target net return in excess of 8%. So I would give you an example of an M&A deal situation. Think about company A buying company B at an agreed price of $2. But the share price might be only trading at $1.95 initially, and that it is due to 2 months of deal completion and some deal conditionality attached to that. So at the time of the announcement, there is a shift of long-only investors wanting to sell the stock at $1.95, but we come in, we buy the stock at $1.95, hold it, and eventually tender it to the offer at $2, thereby realizing a small gain of 5 cents, but that 5 cents is a 2.5% absolute return, annualizing 13%. As I said, on the face of it, this might be small, but we do this over and over and over again. The more Asia merge M&A come to the market, the more we are able to cross up that book, thereby realizing our return of 4 to 5% just in that bucket. Now, sometimes M&A deals, they're just plain vanilla and have low deal risk to completion. But sometimes M&A deals can become competitive. Now, think about company C coming into play and offering $2.20 for company B. So that refreshes the alpha in that trade quite significantly. Did you know that in Australia there's a 45% chance that the first bid is not necessarily the last one? And secondly, relative value. What I mean by relative value is that 2 securities are trading out of alignment to each other. Think of it as a long-short pair. I give you an example in a holding company arbitrage situation, which forms a very large part of our book. In a holding company arbitrage situation is where you have a listed subsidiaries and a listed holding company. Ideally, they should be trading in line to each other, meaning that the sum of the part of the subsidiaries equal the valuation of the holdco. But sometimes the sum of the parts is bigger than the holdco, and sometimes the sum of the parts are smaller than the holdco, and this creates an arbitrage opportunity for us. So the trade here is to go long the holdco and short the subsidiaries, and when the holdco trade expensive at a high valuation, we short the holdco and go long the subsidiaries. And you can clearly understand that market volatility is playing a very important part, as it causes this anomaly either to widen or to shrink, thereby creating this opportunity. And the last bucket is directional alpha. Here we basically identify 10 stocks across the Asia-Pacific markets that, due to some corporate events, have tremendous alpha associated with them. So we are simply outtrying those companies and wait for the alpha to play out. We have developed a toolkit that allows us to capture all corporate events as they happen. If you like, this is the 6th person in the team. So we have filters in place and alerts in place to systematically screen for investment opportunities and events. So we rank these events, opportunities, undertakes some fundamental analysis, and overlay certain risk parameters to quantify the upside and downside for each trade, and then finally it goes into portfolio construction. So Our investment process is 70% deal specific, i.e. going through scheme documentation and so forth, 20% company fundamentals, and lastly, 10% is quantitative analysis, which is our backtesting to ensure that those three core strategies produce alpha in all market conditions. And finally, risk management is absolutely paramount to our investment process. We are pretty well diversified between 50 to 80 investments, and we are making sure that we are not overly concentrated in any one investment or regions. We hedge out broader market risks, and the more corporate events there are, the more we can gross up the book. Right now, we are maxed at 2.5 times leverage, or 250% of gross, and keep our beta or net exposure lean and mean at around 20%. We keep our positions, we want to trade in and out of our positions and with very strict liquidity parameters, just in order to avoid illiquid positions and skeleton in the book. And lastly, we've got dual prime brokers, Deutsche Bank and Morgan Stanley, in order to diversify counterparty risk, and they also provide us with an abundance of stock borrow availability. So moving to the final point, what role does this fund play in a portfolio? Well, we have some investors that use this fund to complement their existing equity portfolio. At the same time, we have fixed income investors at the same time, we have some investors that use this fund to complement their fixed income bucket due to the low volatility and consistency of return. So the key benefit here is for an investor to diversify the risk whilst enhancing portfolio return, as this slide shows. This point here is, by the way, 100% long-only investors in the Asia-Pacific markets. So we are of the firm belief that Asia is the ideal place, and a strategy like ours is the ideal investment vehicle to capture those alpha opportunities. Our alpha are repeatable, consistent in all market conditions. And remember, volatility is the friend of the event manager. So the fund has achieved these three long-term objectives with a net return of 8.3%, 6.1% volatility, and very minimum beta and correlation. And finally, for those of you who want to build that in a portfolio, well, you can use our fund to bridge the gap between equities and bonds. Ladies and gentlemen, it has been an absolute pleasure for me to share our insight, and I hope that you're walking away with a view to consider a strategy such as ours. Thank you so much.
Hi, my name is Stephen Glass, and I'm Head of Research and a Portfolio Manager of the Pengana International Equity Funds. It is a great pleasure to be here today. I always enjoy presenting to family and friends, and partly because I find you can get brutal honesty from them. So my dad's in the audience today, and a few months ago I actually had my father-in-law in the audience, and at the end of the presentation he said to me, "Well done, Steve. You know, behind every successful man is a surprise mother-in-law." So that was great. These are the funds managed by my team. The topic of today's discussion is the Pengana International Equities Managed Risk Fund. That's a mouthful, so I'm just going to refer to it as managed risk. Managed risk is quite literally the Pengana International Equities Fund with an extra risk management overlay. Pengana International Equities Fund is also a mouthful, so I'm just going to refer to it as the PIEF. Before we actually start, I'm going to ask you all to do something for me, please. I know it might seem like a bit of a hassle, but there's a reason for it. Would you all please just take a moment and just consider the key attributes you're looking for from a fund? It would be best if you could just jot them down on a piece of paper, and we'll come back to it a bit later. So it's not a magic trick. I'm not going to try to guess what everyone's got, but there's a reason for doing this. Thanks so much. This diagram over here is, well, it's a fancy diagram and there's a lot happening there, but there's actually only a few things that I really want to draw out of it. So one, the PIF is a long-only international fund. Two, it holds 30 to 50 stocks. And three, and this is the most important point, it is an evergreen fund, which is just another way of saying it is a core fund. But what exactly is a core fund? We think a core fund is the type of fund you use for the majority of your international equities exposure, and you hold the fund for the long term. In order to fulfill this role, a core fund needs to be able to participate in varying market environments, and it also needs very strict and systematic and rigorous risk management. But how do you create that kind of fund? And the answer to that question begins with a story. Fidelity Investments conducted a study of its Magellan Fund. So the Magellan Fund run by Fidelity out of Boston, not the Magellan Fund in Sydney. So they conducted a study of its returns between 1977 and 1990, so the 13 years that it was run by Peter Lynch. During that time, the fund delivered an average annual return of 29% per annum, which is just phenomenal and easily makes Peter Lynch the best fund manager of all time. And Warren Buffett, the best investor, Peter Lynch, the best fund manager. But what they discovered in that study was truly shocking. The average investor in that fund lost money. So think about it. This is a fund that delivered an average annual return of 29% for 13 years, and yet the average investor lost money. How could that be the case? Does anyone want to hazard a guess? Perfect. The fund was a volatile fund with lots of peaks and troughs, and people being people tended to buy after periods of strong performance and sell after periods of weak performance. The net effect, humans, they were a tax on themselves. Now, it's easy for us to sit here and just think about that and reflect on it. One might smile and say, well, that would never be me. But just consider the fact that there were tens of thousands of investors in that fund, probably over 100,000. And the period of analysis is 13 years. So the sample size is indicative of the broader population. Friends, the investors in that fund would have been you and me. We could have been in the same situation. And what that demonstrates is that just seeking returns is insufficient. The path from there to there is actually very important. And with that in mind, the way to solve it, you need to actually have three aims if you're going to be a core fund. One, you need to make money, obviously. Two, you need to avoid large losses, large drawdowns. And three, you need to minimize volatility. Now, as I explain how we go about delivering on these aims, much of what I'm going to say, in fact, I hope everything I say is going to sound really simple and common sense. And I hope that's the case, because that's exactly what it is. It's a common sense, simple approach to invest in. But let's not confuse that with ease of doing it. It's a little bit like golf. It's very easy for me to say, oh, you hit the ball from there to there. It's another thing to do it in different weather conditions, another thing to do it when you in a tournament environment, and another thing to do it when you've got lots of people watching you. It's common sense, it's simple, but that doesn't mean everyone can do it. So the process we employ for actually delivering on these aims begins with our stock selection methodology, which we title the 6 pillars of successful stock selection. It's basically just a checklist of 6 things we're looking for from stocks. So the first thing, cash generation. We focus on cash flow rather than accounting earnings. Accounting earnings can be manipulated. They are guesstimates of cash generation. By focusing on cash generation, we avoid a lot of accounting potholes. 2, reasonable valuation. I use the word reasonable on purpose. We would prefer to buy a terrific company at a reasonable price than a reasonable company at a terrific price. But at all costs, we want to avoid overpaying for a company. 3, growing. Time is the friend of the growing company. It's the kind of place where people want to work. It's the kind of place that has sustainable competitive advantages. Management spend their time in growing companies actually employing strategy rather than putting out fires. These are the kind of companies that tend to provide more positive surprises than negative surprises. 4, positive tailwinds. We like companies that have some underlying drivers to support the company. Either the market is growing or just some underlying drivers, IT companies, companies exposed to aged care, companies exposed to diabetes, so on and so forth. These are the kind of companies that can still succeed even if management makes strategic or operational mistakes. 4, good management. It's very few people that look for bad management, but the reason we put it up is because it is so important to us. And probably the biggest compliment we can give a management team is that they have a long-term perspective. It's very easy for any CEO to just cut costs, fire people, and then boost their short-term profits. They get a nice bonus, and then they go. But you know what? That is not sustainable. We want a management team that are forgoing the short-term unsustainable profits for the long-term big gains. And finally, and this is probably the most important point, unlikely to blow up. We will not invest in companies that have a lot of debt. We do not invest in companies that are binary bets that are worth that much if something happens, but that much if it doesn't happen. We don't invest in opaque companies. We don't invest in stories. We want actual data. We don't invest in companies with material structural headwinds. I mean, sometimes I wonder what we do invest in, but the universe is still large enough. And I think when you actually look at these 6 things, the things that really fall out of it, for me at least, is the amount of risk management implicit in our stock selection process. We're not going to get caught up in accounting trickery. We're not going to overpay. They're more likely to generate positive surprises than negative surprises. We've got positive tailwinds to drive the company even if the company makes mistakes. We've got good management who are hopefully making the right decisions. And if we get that all wrong, everything we do is wrong, we're still unlikely to lose a lot of money because we're not going to invest in companies that are too highly geared and so on and so forth. These are the characteristics of a company that can fit into a core portfolio. However, stock selection is insufficient, which brings me to portfolio construction. If I was to really sit up, take notice of this presentation, and really maybe put an asterisk next to a slide, this is the one I would do it. It's called our portfolio segmentation strategy, and it is at the fulcrum of how we actually construct our portfolio. It is unique, and I know it's unique because we designed it. We basically divide every single company and our portfolio into 3 segments: core, cyclical, and opportunistic. Core are bellwether companies. They're the kind of businesses that generate stable earnings in all kinds of economic environments. Examples are Nestle, Google, Oracle. They don't only have to be large caps. There's some smaller companies there as well. For instance, we own the largest manufacturer of corks for wine bottles in the whole world. The key point is they're dominant companies with sustainable competitive advantages, and we don't want to overpay for them. Cyclical are companies operating in cyclical industries. Examples are banks, agricultural stocks, energy, mining stocks, many industrials. The key to investing in these companies is to make sure you buy them at the right point of the cycle and you sell them at the right point of the cycle. And of course, you never want to overpay. The final category are opportunistic, which are generally rapidly growing companies, so fast-growing, perhaps IT companies. Or another type of opportunistic company is a turnaround. So a company that faces a temporary problem they're trying to fix. The trick to invest in opportunistic is to correctly identify why the future is going to be a lot better than the present for that particular business. Core provides a strong foundation for the fund to really see the fund through different market environments, while cyclical and opportunistic provide the opportunity to boost returns. However, cyclical and opportunistic are a lot riskier than core and require special risk management. For example, portfolio allocation. A minimum of 60% of the fund will always be invested in core, but we can have 0% in cyclical and opportunistic. Further, a maximum of 80% of the fund can be invested in core, but only 30% can be invested in cyclical and only 20% in opportunistic. Another element of the risk management is position size. We can have the maximum position size for a core company is 5%, but the maximum position size for cyclical and opportunistic is 3%. Another element is valuation requirements. Quite simply, we require more return from cyclical and opportunistic stocks than core because they are riskier. So we've got stricter valuation requirements. Finally, trading strategies. We have stop losses in place for cyclical and opportunistic because we don't want to turn a temporary loss into permanent capital destruction. And I think there's really two key benefits that fall out of this approach. One, it doesn't only allow us to participate in different market environments, it encourages us. We are encouraged to think about cyclical businesses. We're encouraged to think about opportunistic. It is very comfortable to sit back and just say, well, I'm in Nestle, I'm in Oracle, life is great because I'm unlikely to lose. But there's actually more ways to make money. So this approach encourages us to look for these ideas, but in a very risk-controlled manner. And I think the key benefit of this strategy that actually falls out of that, the first point I made, is that it actually results in the 30 to 50 stocks that work best together, which is quite different to just trying to create a portfolio of the 30 to 50 best stocks. So now I hope I've demonstrated that a core fund should have three aims, and we go about delivering on these three aims through our 6 pillars of successful stock selection and our portfolio segmentation strategy. We think this is the right type of fund for the vast majority of people. However, there are people with lower risk tolerance as per your risk profiling, and for those people, there is a way to reduce risk even further, which brings us to our managed risk fund. So as I alluded to when I started, managed risk is quite literally the PIEF with a managed risk overlay. For every dollar invested in managed risk, a portion goes into the PIEF and a portion will go into the risk overlay. The way we determine that the allocation between the two is really through collaboration between Pengana and our partners Milliman, but Pengana has the final say. And it's a dynamic process. There are similar funds out there which have a target level they set at the beginning of the fund's inception they just stick to, and that's fine. But for us, we're always thinking about what is the right level of risk given the market environment. So it's a dynamic process. The risk overlay uses its portion basically to buy portfolio insurance, so that is exchange-traded futures. The split between the PIEF and the managed risk overlay is a function of two things. One, our risk targets, which I alluded to, we design in collaboration with Milliman, and two, the current risk environment, the current market environment. These squares show how it works. So each square is an investment in managed risk. The blue value is the portion that goes into the PIEF, and the green portion is the amount that goes to managed risk. During buoyant markets, there's a large allocation to the PIEF, smaller allocation to the risk overlay, and during more turbulent times, the allocation to the risk overlay increases. So the net result is you land up with a portfolio with lower downside risk and lower volatility. Now, we could have actually gone about implementing this ourselves. We don't have to go with Milliman, but we chose to choose Milliman as our partners. Milliman is one of the world's many people haven't heard of them because they're not listed, but they are one of the world's largest actuarial and risk consulting firms. They have offices in 59 countries around the world, over 3,000 risk management employees, and they've been established since 1947. The reason we chose them as a partner is multifold. First, they are truly world leaders in what they do. They've been doing it for a long time. They've got lots of people that have been working on risk management models for a very long time. They've got a proven track record. Their models are very sophisticated. They really are amongst the best people we could partner, or arguably the best people we could partner with. Another reason we partner with them is they have 150 traders around the world who are watching our portfolio and providing the right level of protection on a 24-hour basis. And that is critical if a risk event occurs at 3 a.m. Sydney time. It's good to know we've got someone in Chicago trading appropriately to keep the risk within our targets. Also, because of Milliman's size, we get access to a broader range of securities, and we get exposure at a lot cheaper price than we would be able to ourselves. And finally, we are able to work with Milliman in an integrated fashion, so they get trustee-level access to our portfolio daily. So they are able to design the risk management overlay bespoke for our fund. I should also mention that the Milliman's fees are paid for by us, the managers, so there's no additional fees for managed risk. However, there is a performance fee. There's no performance fee for the PIEF, but there is for managed risk. However, the performance fee is not payable if the fund delivers a negative return during the performance period. So I think when you bring it all together, it's a very attractive structure, and we feel it's like playing a game of tennis with Roger Federer as our partner. We feel like we're in a pretty good position with Milliman on our side. So this is how the funds have gone. This slide over here shows the PIEF versus the benchmark. The green line is the PIEF, the blue line is the benchmark. It's delivered exactly as we hope it would do. It is delivered during negative markets. It tends to outperform. During more buoyant market, it struggles to keep up. Because buoyant markets are really characterized by cyclical and opportunistic doing very well. And by definition, even if we could only have a maximum of 40% in those sectors. So you can see when markets are very buoyant, it's more difficult for us to keep up. But amazingly, we've actually done better than the market. And that's due to stock selection. But I will also emphasize that at no point did I mention that our aim is to beat the market. We anticipate that we will, but our aim is to make returns, avoid large losses, and minimize volatility. The other diagram shows the PIEF versus the managed risk, and the difference between the two is really a function of the amount allocated to the risk overlay. So think of it as though it's like the PIEF swimming with a life jacket on. It's harder to swim, but you know what? It provides a level of security. So all in all, we're very happy with the performance, and we're happy to share any performance data you may want. So, in conclusion, I discussed what a core fund is, how it really needs to have three aims: make money, avoid large losses, minimize volatility. I discussed how we go about delivering on that by having our 6 pillars of stock selection, our portfolio segmentation strategy. And then we went through managed risk and the additional protection we got from Milliman and why we think that is such an attractive structure. We think this is the right way to manage money. It is the way that we manage our own money, our family money. I don't have money elsewhere, so this is where my money is, and I believe it is the right way to do it. And what I'd like to do now is I started off by asking you to just think about the key attributes you are looking for from a fund. And if you don't mind, will you just refer back to those attributes and just consider if the PIF or the managed risks actually fulfill them. So thank you very much.